So I was asked a very interesting question at a recent webinar, and the question went like this. If my portfolio comprised of just two funds, and this can be an actively managed mutual fund, index funds, an ETF, or a combination of these, but if I could have only two funds, then which ones would those be? Now, I typically ignore such Konsa mutual fund Kharidun type questions, but this one was a bit challenging because we have multiple categories, different capitalizations, many investing styles, and so on, which obviously complicates matters. Anyways, I did not have an immediate answer for the gentleman. I asked for some time, and over a couple of days, I looked into different parameters like returns, volatility, drawdowns, any existing research I could find, etc. And after looking at a few combinations, and to my surprise, the two funds I was most comfortable having in a two-fund portfolio were a momentum fund, and secondly, this portfolio would also have a value fund in it. Now, you must be wondering why momentum and value. I could have chosen a Nifty 50 and a Nifty mid-cap, or maybe a small cap fund and the Nasdaq 100 could have been an interesting combination. But no, I chose this odd combination of momentum and value. And because, like Christopher Nolan, I have already given you the prestige, it's time we look at the pledge and the turn. Let's begin. Alright, so very quickly, let's understand momentum and value 101. So when Yuvraj Singh smacked that 6-6 against England in the 2007 T20 World Cup, the commentator Ravi Shastri could be heard saying,
"Every chance now. Yuvraj must be favourite here to put this 6-1 into the crowd as well."
So what Mr. Shastri meant is that Yuvraj was on fire, which means he had the forward momentum to continue doing what he was anyways doing and was very likely to hit the 6-6 in that over. In more technical terms, momentum is the tendency to exhibit persistence, which in simple language means investments that have performed relatively well will continue to perform well for some more time, and likewise those that have not done well will continue to perform poorly, at least in the short term. To many of us, this concept might seem a little counterintuitive because conventionally we are used to believing that all investments should be bought low and sold high. It was particularly difficult for me as I had started my education with the value style of investing, which in cricketing terms is like the Rajasthan Royals, who in 2008 spent less than 60% of the maximum budget. It was a team without superstars, with players like Asnotkar, Tanveer and Pathan stepping up, and yet they shocked the cricketing world by winning the inaugural season of the Indian Premier League. In what can be described as Royals' Moneyball moment, the management there had picked players who were priced significantly lower than the real value, and this gap between the current price and the true worth is what the value factor identifies. So if you look at it broadly, both momentum and value are based on market anomalies, which happens when investors over or underreact to information. We know that both these strategies don't work all the time, and we saw this in a previous video of mine on factor investing. Thirdly, the investor profile is completely different, with the value investor focusing on research and the long term, while the momentum investor looks out for short-term price movements. But the one characteristic that really caught my eye is that both these factors seem to be negatively correlated, which almost never happens in equities. So in this exercise, because my entire portfolio is just two funds, I felt this unique attribute could help me achieve all three objectives of my portfolio, which includes returns, asset allocation, and risk management. In fact, let's start with this and examine the results of a study where I looked at data from the year 2006 onwards for a couple of our representative indices. The first index is the Nifty 200 Momentum 30, and currently there are quite a few mutual funds that have this option. The second one is the Nifty 500 Value 50 Index, which I think is being offered by just one AMC. Now, over these last 17 years, our momentum index and the value index have independently done rather well, with the momentum strategy leading the race on a lump sum and SIP performance basis, and also in terms of volatility. In fact, it's very tempting to conclude that momentum is the better strategy, but
रुको जरा, सबर करो.
But there's a good amount of research that says that a combination of momentum and value can together give us even better results, and that will be our focus for the rest of this video. Okay, so let's do the easy stuff and start with a portfolio where 50% of our capital goes into the momentum index while the value index gets the remaining 50%. Understandably, the result is nothing but an average, and over a 17-year period, this comes to a respectable 16.2%, which is a lot higher than the more popular indices such as the Nifty 50, the Midcap 150, and even the Microcap 250 index, about which we recently learned in a dedicated video. But because we have learned even more stuff on my channel, and especially the importance of rebalancing, I applied an annual rebalancing on our 50-50 combination, which gave me a tiddly-bitly improvement of 0.2% in returns. In fact, I even tried a 6-month rebalancing, which further improved the combination CAGR to 16.6%. But because the tax rate on short-term capital gain is a bit higher, I think the post-tax returns for all three options, that is, without rebalancing, annual rebalancing, and a 6-month rebalancing, will all come to pretty much the same level. I also looked at the 50-50 combination on a rolling return basis, and there are enough historical indications here that this strategy can offer anywhere from 15 to 16% per annum. In fact, the more I look at it, the more convincing I am of my two-fund portfolio, because in addition to strong performance, there's an inbuilt asset allocation with two investing strategies that are at opposite ends of the spectrum. I mean, look at this data where I've mapped the yearly performance of the momentum and value indices, and it isn't difficult to see that these two are not cut from the same cloth, with a performance difference of at least 15% in the year 2006, 2009, 10, 11, 13, again in 2014, 15, 16, 18, 2019 and 2022. It's the understanding of data like this that gives investors like you and me that little edge. And if you want to sharpen that edge, then do explore enrolling for the short and sweet course on quantitative investing strategy. Conceived and presented by Kirubakar Rajendran, this practical course will help you build foundational skills in backtesting, logic, and screening, and will also help you understand how to collect, clean, and analyze financial data. Additionally, and more interestingly, Kirubakaran would also take us through a rule-based investing strategy that will not only help us pick the best stocks, but will also clearly tell us when to enter, when to exit, and how much to buy. Do check out the course details on Fisdom Academy, and if you like what you see, then do register using the link in the video's description, and don't forget to apply the code SKN20 for a 20% discount on the course fees. Alright, so we've seen something very simple so far. We put 50% in a momentum-based fund, we put 50% in a value-based fund, and we are good to go. But what was a slight botheration for me was that we were not really using the up and down movement that both these factors go through, wherein in some years momentum does really well, while in other years value is a lot better. So I tried out a couple of techniques of my own just to see if complicating matters can help me with a little extra returns. Okay, the first method I used is a momentum-based switch method. I'm sure you've never heard of this one before, and that's because I just invented this phrase for the purpose of this video. Now, the way this switching method operates is a lot like how price momentum works. So if the Nifty 200 Momentum 30 index goes up by 20% over a 3-month period, we then assume quite fairly that there is positive momentum in the markets, and therefore it makes more sense to be invested in the momentum index. For instance, the months of February, March, and April of 2021 saw a healthy move up in the momentum index, which means per my strategy, I should now be putting all my eggs into the momentum basket. And likewise, a 20% drop in the Jan to March period of 2020 would have prompted a switch to the value strategy, which would have stayed that way until the next switch happens in April of 2021. As I said, it's a bit complicated with periodic switchings, but when I did this exercise over a 17-year period, it all came to only 4 switches that needed to be done, which happened in the months of March 2008, May 2009, March 2020, and again in April of 2021. Now, honestly, I was a bit surprised to see only 4 switches, but then I realized why. Because although we always think of the up and down movement in terms of the Nifty 50, I was actually using the momentum index to figure out when to invest and when to exit. In fact, there was another surprise, and this one came on a performance basis when this momentum-based switching strategy gave me a 17-year CAGR of 22.2%, which is a good 6% higher than our previous 50-50 combination method. I think a little more work is required here, but I liked what I saw. And because I didn't want to disappoint Mr. Value, I also tried an alternative approach using a P ratio based switching method. Now, just like how we used P ratio bands in the Superman video, in this case, I defined the cutoff as 18 and 24 for switching in and out of the momentum and value indices. So if the Nifty 50 P ratio were to go below 18, then I would switch to a momentum strategy, and when the ratio crosses 24, then I would become more value oriented. Honestly, I had big hopes for this approach, but it didn't work as much as I expected, and the 17-year CAGR came to 15.1%, which is still quite respectable. Anyways, this was a very interesting experiment, and just to help out, I'm attaching a worksheet in the description where I've mapped the closing monthly values of the Nifty 50 and the two indices that we've discussed in this video. If this content has made you a little curious, then do try out the different combinations of momentum and value, and feel free to bring in more variables like the P ratio, volume, moving averages, etc. that can help you present a more superior model. So just to recap and conclude, it is my belief that a combination of momentum and value are perfectly suited for a two-fund portfolio. What makes these two factors a perfect marriage is their high performance in isolation and the fact that they are weakly correlated, which adds an asset allocation element to my portfolio. And thirdly, an investor can improve the performance of the portfolio without adding to volatility, and we looked at a few ways of doing that in this video. If you like this video, then do give it a thumbs up and also leave me a comment on how the strategy can be improved further. As always, thank you for your time. Do subscribe to my channel. Please share this video with your friends, and I'll see you 3 days from now. Until then.